Rob's Child here. Welcome to Chapter 28 of Security Analysis. Nothing I say is investment advice, and my intention is to supplement and open the contents of this book for discussion, hopefully in the comments below. So here we are, Chapter 28. This chapter, for me, is really the beginning of the creme de la creme of la creme, right? This is where we really get into his thought process regarding stocks, which is what most people are looking for when they're investing. You know, you have the biggest opportunities available to you typically in stocks, unless, high yield corporate is cheap enough, as we've discussed before. But anyways, so we'll go through the points of this chapter. It's one of probably my favorite chapter of this book so far. He all in all, in short, he pretty much sums up that growth stocks are like gambling, basically, and value stocks are great. Like, value stocks actually make money. They're real businesses. They make real money. And there's usually plentiful amounts of them that are plenty cheap that you can buy them with confidence and sell them when and if they ever get overvalued. I think that's the entire theme, really, of this chapter here. But let's go through the points, maybe discuss a few things. So, title of this chapter, Newer Canons of Common Stock Investment. So we start with the suggestion that perhaps instability of individual companies could be offset with diversification, that earnings trends can be a useful indication of investment merit. So if earnings are going up incrementally, he says a useful indication. It's important to really read the words that he writes and not assume things. This is something I've come across many times in the book, where I think he's thinking something, but then he really clarifies what he actually means. In this case, the earnings being useful, not something to toss out. And then he asks if stocks should be considered an investment at all, simply because, before this chapter, the first giant chunk of this book goes over fixed value and how that all works, and how that, in the olden times, fixed value was the only true investment. And so he's trying to discover what we can call a true investment versus a speculation versus, investment versus, well, he doesn't even define whatever else other people are doing. He's discovering in this chapter, what can count as an investment, particularly in an individual stock. And that's the thing he prefaces is this chapter, like I just mentioned, instability of individual companies can be offset by having a basket of them. And he's referring more to the value stocks in this case, but I think that can apply to growth stocks, obviously, as well. So then on page 363, we have the three general approaches, I quote, three general approaches to trying to figure out what stocks to buy. And there's three sections here. The three approaches. There's secular expansion as a basis, so the whole market growing. individual growth as the basis of selection. So if a company is growing really well, if that's your basis. And then the third approach being selection based on a margin of safety principle. So the secular expansion basis, we start with three assumptions: that the national wealth and earning power will increase. So we're seeing like the whole market's going to be growing, therefore I should buy stocks. That this increase will include more resources and corporate profits. And these increases will take place through the normal process of investment of new capital and reinvestment of undistributed earnings, quote. So, I laugh a little bit because it's, interesting how you have people like Ray Dalio putting out the principles for dealing with changing world order, like his book and his videos. If you're watching this, you're probably highly aware of his work. That kind of goes against, this first assumption. When we're looking for secular expansion, we're looking for a country that's obviously going to be growing secularly, that the national wealth and earning power will increase. Current birth rates in the United States right now may spell out that not occurring. You look at India, you look at China, Brazil, some of these truly expanding economies, and a secular expansion as basis functions better, I think, in other countries. I think that's what may push a lot of investors today, August 2023, into some of these more emerging markets, obviously. So, anyway, so we go on to the fact that he infers that you should only pay a reasonable price for securities to offset the risks and diversity, and diversify those purchases. So, considering the risks, you want to offset them. Make sure you only pay. You're not overpaying. So that sets up kind of a basis for what he really concludes by the end of the chapter here. But so we go on to the second approach, the individual growth as basis of the selection. He starts by saying, well, maybe certain favored companies have reliable growth, maybe. And then successful growth companies are great, but how can you be accurate in picking them? And how can you determine a good price? And that's something he repeats ad nauseum, I believe, in previous chapters too. How can you figure out what a growth company is really worth? It's kind of like shooting in the dark a little bit. And, as far as how much earning power can this company have in the future? Certainly today with AI coming out, it seems infinitely valuable, the power and value that's going to have in the future. It doesn't have that. It doesn't. But we don't see the full value of it yet. It's not paying dividends. You're not finding value stocks paying out its shareholders, the extra earnings from their earnings of AI companies. Of course, you could argue, some of these big companies integrating it, like Microsoft and such, are paying out dividends. But yeah, they're tiny, and that's why they're so, relatively overpriced compared to, normal metrics. The Microsoft, Nvidia, these companies are functioning today at their current price point as growth stocks, as major growth stocks. And that's the thing. They might be right. People investing in these things at these levels, they might be right in the future. When is this going to pay off? And how much is it going to pay off is up for grabs. We actually don't know. And so that's, I think, where Graham really draws the line here and says, watch out, everybody. And then he makes a point here, being in the 1940s, he criticizes the National Investors Corporation's definition of growth companies being growing cycle to cycle. So a growth company, if it grows from this cycle to that cycle to that cycle, then it's considered a growth company. He doesn't like that very much. One of the dilemmas with growth companies is that they have a short history with only really possible explosive growth. In general, again, like with a situation like Microsoft, it's hard to imagine Microsoft going bankrupt at this point. But it's priced like it's a growth stock right now, and that was the point I was trying to make. But moving on, he says, so growth companies obviously require a lot of investigation, and so if you're going to be investing in really growthy stuff, you really want to know what you have. And so, and that's the thing he says here too. All the way back in 1940, the research of new technology can be valuable, but it needs a lot of digging. Personally, she's not paying me to say this for the viewers that I end up getting on these videos, but Kathy Woods, I'll let her do it. She has these ETFs that she picks the growthiest companies, and she had spectacular results when rates on the 30-year went so far down during the COVID bubble. It became clear that she is picking the winners, and that's going to, as far as having a growth part of your portfolio, that's my favorite area. She hand selects, she does the digging. That's what her company does. And so that's some my 2 cents on there. It gives me confidence having the growth portion of my portfolio be invested in her funds. Moving on, he questions, on growth stocks, is the growth already priced in? There's no way to tell if it's too high, even if you know the future earnings for a long period. If you were to accurately predict the earnings over the next 10, 20 years, he says, you still cannot accurately determine what the current price should be. And he didn't go into detail with that too much. I think what he's referring to mostly is maybe the margin that the company is going to be able to make. At the end of the day, there's an expectation eventually for a stock to produce dividends. Otherwise, it's just a piece of paper that represents ownership of the company. Eventually, it needs to pay. So I think that's what he's referring to in those kinds of terms. But then he comes up with a solution. He says maybe buy what's not popular in growth stocks. One thing I want to bring up at this point is that he likes people that we mentioned in this in a previous chapter. He likes people that can find areas that they like, And I think that's pretty cool. Like, to have your own specialized area, whether it's, a certain industry or a certain type of security even, um, that that's a way that you can potentially get a leg up on the market by really thoroughly understanding a certain area. But anyway, we're going to move on. He states that stocks are an investment if, and there's 2 points here, if they're carefully and skeptically and thoroughly examined for their potential future, not by generalizing. And so, really digging deep into the company, like I said before. And then number 2, he says a quote here that I absolutely love, and it reminds me so much of Warren Buffett. I feel like Warren Buffett must have this quote like printed on his dresser or something. He says, quote, the price paid, stocks are an investment if quote, the price paid be not substantially different from what a prudent businessman would be willing to pay for a similar opportunity presented to him to invest in a private undertaking over which he could exercise control. End quote. So talk about the absolute opposite of a meme stock. This really sets in the idea, and this is how Warren Buffett thinks, and he says this all the time if you ever see him talk. When he's buying a stock, he's imagining in his head that he's buying the whole company, at that price for that chunk of the company. He imagines that he's becoming really, actually becoming an actual owner of that company. And that's such a great way to think. Too many people buying stocks, probably most people buying stocks, don't have that idea in mind. They don't think, okay, this is the price of this company. Look at the market cap. And this is what the company is able to do and produce and earn. Would I buy that whole company if I had the money to buy the whole company? And if the answer is yes, then it's probably a good investment. And if it's no, then it's obviously not a good investment. So I put lots of stars next to that quote. I think that's going to be one of my top quotes from this entire book, especially so far. So then we move on. Of course, there's a but. But in reality, the liquidity of stocks and of companies create a natural premium compared to if you were to actually be a private buyer of a private company. He says the liquidity can add a premium because it's just more liquid, and that sort of makes sense. But he says, if that's your mindset, that the premium should not be more than specifically 20% more than what you think it should be worth. So you have that little cushion there. So if you're determining a company is worth a certain amount, cut off 20%, let's say, and if it's worth that much, then the stock can potentially be worth that much. So I found that very interesting. He has a very specific number in there. Not a lot of those in this book, by the way. That's one of them. He says, I'm sure there's more moving forward. So then we get to the third approach for selecting stocks, and it's based on the margin of safety principle. And it seems to me that this is his creme de la creme method of finding stocks to buy. So we start with the points that in order to do this, you have to find something that seems worth more than the current price. of what you're buying, and you have to be reasonably optimistic about the future of the company. And then how to do this, he divides it into 2 points. The first point is when the general market is low, regarding how to find stocks that are in these 2 categories. Sorry. So how do I find stocks based on the margin of safety principle? So one way is if the whole market's low by quantitative measures, as in companies clearly have plenty of earning power and everybody just doesn't like stocks right now. That's one approach. And so we'll start with that one. He says, one way you can do this nowadays, very easy with all our computer charts. He suggests draw a straight line through the midpoint of the swings and buy below it and sell above it. And most of the time, it'll probably work. He says that that isn't a terrible way of investing. When something's cheap, buy it. When it's expensive, sell it. But then he goes over some issues with that. Mainly one issue. The main issue being if the fact that the market character can change, and also, and then the second problem is that it takes a lot of patience. You can wait a long time before you see a market correction. Think the 90s. Think, there's various periods. He mentions, just the small period from 1936. Wait, I think he said 1927 to 1929, like that period. Like if you're just waiting for a correction, that would be everybody's saying how rich they're getting in the stock market during 3 years, and you're just sitting on your hands being like, everything's overvalued, I'm not buying that. Well, if you did that right, you would have made out like a bandit. But but the thing is, bubbles can continue, that can continue going upward, and so it's problematic to try to time any market at any point, really. And then the market character changing, and think of the before the dot-com bust, the market character, after the dot-com bust, before the great financial crisis, after, before the Great Depression, after, before the 70s inflation, and then after the 70s inflation. You have plenty of places throughout history where there's clear market character changes, and those are very dangerous. And so, if you're trying to do this swing thing, you can get it right. It's possible, but watch out, I think, is what he's trying to say, if that's going to be your method. All right, and then so we get to the second how to find stocks based on margin of safety, and we get to he says there's the second point is to find individual stocks that are undervalued, even when the general market isn't cheap. So to just try to pick and choose. So he says, first off, to find stocks that have qualitative measures that are really strong on every front, and quantitatively it's cheap and it looks really great, he says, is very rare. He says this is a rare thing. You can find them, but they're rare. He prefers what he discusses as, or describes as, a reasonable abundance of stocks out there, of stocks being quantitatively cheap, but with an average future. So not one that has all these he says every qualitative measure. In other words, like from every angle, this company is going to make tons of money in the future. That he says that's one way to do it, but the other way to do it is find companies that are chugging along, making plenty of money, and they happen to be cheap. That's where Graham, says that's how you do it, and that's how he concludes this chapter. He basically says that at any point you can go through markets, you can find stocks that are clearly undervalued by the numbers, by the quantitative data, that you can have reasonable confidence in their future. Companies that come to my mind right now could perhaps be in this category: T-Mobile, not T-Mobile, AT&T and Verizon. They have a very, very strong dividend history. I think Verizon may have cut their dividend by a little bit for seems like the first time ever, if I remember correctly. And the market's freaking out. The stock went so far down that their dividend is currently something like 8 or 9%, which is very high for a dividend. And it seems to be, it's a very unloved stock right now. And I think that might fit in this category. But there's a lot to learn. There's a lot left in this book as to you really figure out the exact quantitative measures that he wants to use to discover these kinds of stocks. So we have a lot to learn left in this book to determine if that would be true. So they're easy to find, and one reason they're easy to find these kinds of stocks, he says, is because the markets tend to discriminate against value stocks, especially when earnings show weakness. I mean, in the few years that I've been studying the financial everything, securities, all of it, I've seen that plenty of stocks that do this. And it's so true. You have these growth companies that have nothing underneath them. They're not worth, they could, if they sold all of their assets and liquidated, you'd be left with nothing for sure, based on the valuation of them. And yet markets love growth. The reward is greater if you're correct. But again, what's a fair price today? How do you know? He says you don't know. Maybe Kathy Wood knows, but he's not interested in that area. So again, that's how I get my philosophy in investing. I'll let Kathy handle the growth stuff, and maybe I'll be able to pick some value stocks from reading this book that I will believe in. And so they sell very cheaply compared to, he says, what private ownership would value it at, and that's a common thing. So maybe take a value company, scale it down. If Verizon was 1/1000th of its size, and you could actually afford the whole thing, or maybe probably smaller than that even, I don't know the numbers, you really could afford buying the whole company, and you looked at, okay, they owe this much, interest rates are high, that's one of the reasons it's down, by the way. Do I want to buy this company for this price? Looking at what it can do, the customers, the money coming in, the money going out. Do I want to own this company? And so, and he says it's common that you can find companies that are very cheap compared to what would normally be considered to be the value of those companies. And so that's the main last point here. one more point. So he ends with saying that basically that true investment opportunity is in undervalued value stocks. That's what it kind of boils down to. And then he goes on further to expand that idea into, his discrimination against growth stocks, in my estimation, a little bit, stating basically that growth stocks are not dependable and therefore not really an investment. He sees them as kind of too speculative to be called an investment. And so he says directly that he thinks that they should not be called an investment. That they should be called what he says, something else. And that concludes that chapter 28. Please discuss anything and everything in the comment section below. Hope you enjoyed this chapter with me. And I'll see you next time. Rob's Child.